Welcome back to The Explainer. Okay, today we are unpacking the actual financial mechanics of being a sole trader. And look, I totally get it. Accounting can sound like a bunch of dry, boring math, but I really want you to think about it a little differently today. Think of it as the ultimate scorecard for business success. Because if you've ever wondered how small business owners actually track whether they're winning or losing out there in the real world, well, you are in exactly the right place.
All right, here is our roadmap for today. We'll kick things off with what it actually means to be a sole trader. Then we'll build our two critical scorecards, the income statement and the statement of financial position. After that, we'll look at year-end adjustments, and finally wrap up by comparing service businesses to trading businesses. Let's dive in.
Section 1. Being a sole trader, the boss and the scorecard.
So a sole trader is simply an unincorporated business owned by just one person. And there are some massive immediate trade-offs to setting up your business this way. On the one hand, you've got total control. You get to make all the quick decisions, it's incredibly cheap to get off the ground, and honestly, the best part, you get to keep literally all the profits and maintain complete financial secrecy. Pretty sweet, right? But on the flip side, you face the harsh reality of unlimited liability. This means your personal assets, we're talking your own bank account, maybe even your house, are completely on the line to pay off creditors if the business tanks. Plus, it is way harder to raise capital, and you bear the entire weight of all those day-to-day decisions totally alone.
Moving right along to Section 2, the income statement, the video of your performance.
Because the personal stakes are just so incredibly high for a sole trader, you need rock-solid proof that you are succeeding. Think of the income statement like a video recording of your financial activity over a whole year, and the very first part of this recording is the trading account. This section only cares about one thing, the buying and selling of physical goods. The formula here is beautifully simple. Your gross profit is just your sales revenue minus the cost of sales. It answers the most fundamental business question there is. Did you manage to sell your inventory for more than it cost you to get it in the first place?
But wait, how do we calculate the exact cost of those goods? First, we really need to define an accounting term that trips a lot of people up, carriage inwards. It sounds fancy, but it's just the essential cost of transporting purchases into your business. So if you pay a delivery fee to have a bunch of inventory shipped directly to your shop floor, that cost actually gets added to the total value of your purchases. And that brings us to the full cost of sales formula. Let's imagine a fictional retail trader. We'll call her Selma. Using this exact formula, Selma can figure out to the penny how much her sold goods cost her over the year. She takes her opening inventory, which is just what she started the year with, adds her net purchases and that carriage inwards we just talked about, and then simply subtracts whatever inventory she has left sitting around at the end of the year, her closing inventory. It even lets her subtract inventory she might have swiped for her own personal use, which we call drawings. It's just a perfectly balanced tracking system. Okay, let's pause for a second and ask a really critical question to see how this all connects. Think about this. How does a simple, honest error in counting your leftover closing inventory ripple through your entire financial scorecard? Like, if you accidentally overstate what you have left on the shelves in the back room, what actually happens to your gross profit?
Well, here is the kicker. Overstating what you have left makes your cost of sales look artificially lower. Why? Because you are subtracting a much bigger number at the very end of the formula. And if your costs look lower on paper, it dangerously inflates your gross profit. This brilliantly illustrates why accurate inventory counting is an absolute must. One sloppy mistake completely distorts your sense of how well the business is actually doing.
All right, so once we finally have our accurate gross profit, we drop down to the second half of the income statement, the profit and loss account. This is where we see how Selma factors in everything else to find her true bottom line profit for the year. She takes that gross profit, adds any other miscellaneous income, maybe she gets rent from subletting a back room, and then subtracts all her normal operating expenses. We're talking internet, rent, electricity, and carriage outwards to our customers. That final resulting number? That is the ultimate proof of her business's performance.
Which brings us to Section 3, the statement of financial position, the health snapshot.
So, if the income statement was a video of your entire year, this statement is a precise freeze-frame snapshot of your business's health on one specific date. It's totally anchored by this fundamental equation. Every single asset the business owns is funded either by the owner's own capital or by outside liabilities, which are just debts owed to others. The two halves of this equation literally must always balance perfectly, no exceptions.
Now, when we list our current assets, meaning the assets we fully expect to convert to cash within a year, there is a strict structural rule on this statement. We actually have to arrange them in increasing order of liquidity. So we start with the least liquid, inventory, because, that takes time to actually sell. Then we list trade receivables, which is money customers currently owe us. Then cash sitting in the bank, ending with the absolute most liquid asset possible, literal cash in hand.
So what actually happens to the owner's stake, their capital, over the course of the year? Well, here's the exact flow. We start with the opening capital. Then we add in that hard-earned profit for the year we calculated just a minute ago, which directly increases the owner's wealth. Finally, we subtract any drawings. Like, remember when our trader Selma took $300 of inventory for herself? Or maybe she pulled out some cash for a holiday? That comes out, and that leaves us with the closing capital. This flow is what so neatly connects our two scorecards together.
Moving to Section 4, making year-end adjustments, ensuring a true and fair view.
To ensure these scorecards present a totally true and fair view of economic reality, we have to make some critical tweaks right before finalizing the numbers. Because remember, we aren't just tracking cash, we are tracking the timing of economic events. For example, we add accruals to capture expenses we've incurred but haven't actually been billed for yet. On the flip side, we subtract prepayments for things we paid for early but haven't used up. We also calculate depreciation, which tracks the gradual wear and tear of physical assets, like your delivery vans, over time. And finally, we create a provision for doubtful debts, because realistically, we have to anticipate that, well, not every single customer is actually going to pay their bill.
And finally, Section 5, service versus trading businesses. Donnie the dentist.
It is really important to understand that not all sole traders are out there buying and selling physical goods on shelves. Meet Donnie the dentist. Donnie is your classic service-based sole trader. He provides highly specialized care directly to his patients. He's not buying crates of physical goods to resell at a markup. His primary revenue comes from his time, his skills, and his expertise. That means he completely bypasses dealing with tangible trading inventory.
And because Donnie doesn't trade physical inventory, his financial scorecard is actually a whole lot simpler than Selma's. He gets to skip the trading account and that entire cost of sales calculation completely. Instead, he just takes his income straight from his dental fees and directly deducts his running expenses, clinic rent, staff salaries, equipment depreciation, to find his final profit for the year. Much cleaner, right?
So, I want to leave you with this final, absolutely vital thought straight from the source material. The most important purpose of a business is to make a profit. But let me ask you this. If your scorecards, your income statement, and your statement of financial position are totally blank or mathematically flawed, how will you ever truly know if you're actually winning? Mastering these mechanics isn't just about passing some accounting class. It's about gaining total clarity and control over your entrepreneurial journey. Thanks for joining me on this explainer, everybody. Keep tracking those scorecards, and I'll see you next time.